Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, September 6th, 2022. Welcome back to the podcast, George.
Great to be back, John.
Good to have you. And man, I cannot believe it's September. Although we could probably lament the end of summer for an entire episode, let's be a bit more productive and talk macro and markets. As is typical of a post-Labor Day weekend, the market has an almost back-to-school vibe, and markets are starting to discount the risk that lie ahead for the month of September. But before we get into what we should be looking out for during this pivotal month, I think it would be helpful for you to set the stage by recapping the last couple of weeks of August into early September, Jackson Hole, the August employment report, etc. So why don't you go through that for our listeners, George?
Absolutely. And August ended up being a pretty interesting month. Having started off with, back then, which was the first monster or the return of a very large NFP print, that monster July NFP on August 5th, and kind of markets were kind of in a feel good moment. We had seen rates rally all throughout the summer, kind of staying relatively low versus where they were in June at the peak. You saw risk markets doing well and really climbing the wall of worry. All of that kind of lasted up until the middle of August, after the S&P, using it as an example, got close up to the 200-day moving average and close to that 61.8 retracement level from the high-low print of the year. Something that you and I have been covering all throughout the summer, which we were just amazed by. What people were thinking it was the start of a new bull market, and we were more of the view that it was more likely a bounce and more of a bear market rally. Right now, I think that's probably what ended up being the case. We've seen a pretty big give back in all of those gains in the equity space, and part of it has been in result to more hawkishness coming out of both Fed speakers, as well as what we heard from commentary and speeches at the Jackson Hole event in late August. And both the curt but very succinct speech by Chair Powell, which really layered on that they're not going to end until they really see inflation come back towards their target, and are really adamant about getting inflation under control, and also comments from the ECB folks as well. All of that kind of led to a kind of perfect hawkish storm at the end of August. Rates backing up pretty aggressively quickly, and unwinding of the curve, a re-steepening of the 2s10s curve. I mean, still inverted, but a pretty big move of over 30 basis points. Globally speaking, the rise in rates was actually larger overseas, and that also helped push up the intermediate sector for U.S. rates. We had, in the last month or so, through the time of this recording, about 50 plus basis points move in the 10-year Treasury, but it was more than double that for the 10-year U.K. gilt bond. And so, there's been a kind of this massive move in global rates, partly in response to Europe is dealing with an energy crisis, and the fiscal response and the solutions that they're coming up with will probably end up with more bond supply. So that's adding to pressure on the global bond markets, and it's also having a beta effect on U.S. rates. And then we had a pretty decent NFP, and then markets unwound that, and here we are after NFP, after Labor Day, and a pretty big sell-off as everyone gets back in their seats and gets ready for IG supply, quantitative tightening, really kicking up a notch, and a whole host of other things, which we'll discuss in the second part.
Yeah, all right. That was pretty comprehensive discussion of kind of what brought us to this point. Looking forward, as we have the ECB this week. There's also a ton of Fed speak. So I guess the question is, what can we learn that we really haven't already? And looking further afield, what are your preliminary thoughts on the FOMC meeting, the other pivotal events for the month of September, and what is priced into rates markets currently?
So this week it's going to be important to see, does Fed speak kind of remain on the same message that it's been for the last couple of weeks around Jackson Hole. It does feel like there's some sort of unison that's formed among most Fed speakers, even the most dovish ones are all sounding hawkish. they're all kind of sending the signal and the same message that Chair Powell was conveyed in his speech at Jackson Hole. So if that stays on track and there's no deviation from that, then that that they're really adamant about, again, getting inflation under control. I feel like the maybe we won't learn much, but at least if it's consistent, that's going to matter. I think that this will. I'll discuss the Fed in a second because we still have to get through the ECB, but I think it does then line up for us. Especially going into the blackout period where Fed speakers won't be speaking and unable to really, opine or offer any sort of guidance or post CPI, and we'll see what CPI brings us. I feel like this week will be really critical for Fed speakers being consistent to the message that they've been delivering. It does mean that the skew should stay towards the hawkish side. And so if and this is my opinion now, if the markets are priced close to 50-50 on a 75 hike at the September meeting, I think given the hawkishness that we've heard of late, the Fed should just take that and run with it and actually deliver the 75. It doesn't have to be fully priced in other words. For the ECB, I mean, it's the consensus has formed around 75 basis points for this meeting as well on Thursday the 8th. Chair Powell is also speaking during that day, so it could be a double header in terms of the central bank volatility. But nonetheless, unless the ECB were not to deliver 75, I think a lot of it is priced in, both in the FX side. That's what our FX team thinks, as well as the idea around what's priced in for the rates markets in Europe. There's been a pretty big sell-off already. So if we get some sort of sell the rumor by the fact kind of concept into the ECB, unless they are even more hawkish, which will be hard to see unless they were to change their balance sheets or something like that, and the policy around their PEP and maybe do a QT version of their own. Unless we get news of that, it'll be hard to get more hawkish. And then that kind of sets the stage for CPI next week, and then the Fed meeting thereafter. For CPI, again, I think it almost does feel like a coin flip. I mean, we have had lower energy prices. I mean, the risks, should be for contained and maybe even lower headline on the monthly numbers. But I think that's been priced in too for the markets. I mean, I think that we've kind of seen that in real time with gasoline prices coming lower. So I think the shock would be more if core is sticky, and then that really then puts the Fed clearly in the pole position to do 75 basis points. And then for the meeting, again, if it's a coin flip around CPI, but if it's close enough to being a 75 hike, I think they will deliver it. And then it comes down to how are they going to address the dots and how they're going to update their forward guidance. And those are things I plan to cover in the upcoming podcast that we do before the meeting. But I think that is what the markets will be anticipating and pricing in post CPI, and that should keep the boil in rates and pushing them higher and just kind of keeping them above the 325 handle across the curve. Because if the Fed is going to go 75 and that pushes up the upper bound towards 325, there's really no reason why we should have an inverted Fed funds to the Treasury curve, not this soon at least. And so I think that keeps pressure on rates. Then by extension will keep pressure on credit, and then eventually towards equities. And and the further this goes, this will get to what the Fed is ultimately trying to achieve, which is financial conditions tightening. In our view, there has not been enough. There's been plenty of repricing in both rates and mortgages, and those two markets can sell off more too, but the magnitude is more behind us than ahead of us in terms of the sell-off in U.S. fixed income and high quality fixed income. But down the credit stack and into credit and into equities, I should say, there's more risk premium that has to get built in, and I think that's what will then finally get that financial conditions tightening the Fed is looking for, which at that point will then decide if enough's enough. But I think that's what we're all wrestling with. It's the start of it feels like back to school, like you mentioned in the beginning. And I think with the supply, the QT in effect, the Fed ahead of us, ECB in between, all these Fed speakers and CPI, it's going to be what will set up for the balance of the year. If we have a proper risk off, it should be starting in the coming weeks, if not months.
Wow, that's a ton. And then at the same time, that financial conditions tighten, the Fed continues to unwind its balance sheet, the there's going to be a huge amount of IG issuance. There's this is shaping to be a really, really busy month. So for our listeners, I would encourage you to check out George's strategy reports for more on this and going forward. And if you're not receiving them directly, please get in touch with George. Great stuff as always. Thanks again, George.
Thank you, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.